When we talk about the three gap patterns, there's obviously three gap up patterns and three gap down patterns. But when we're talking about, in this particular example, the three gap up patterns, there are three patterns within the 20 plus patterns in the pattern type up index or category that make up the three pattern group that will identify gaps before the gap. These are identical indicators in which you have 12 or more identical indicators in a shape pattern like a BOC pattern, in one pattern like 14 in one pattern, or you can have two like 9 and 6 would make 15 in two identical indicators, and we call that a two pattern group. And then of course there's a three pattern group. I have seen three groups, 7 in each group at one time, and it gapped up real nicely. So I generally say you want to have 12. There's many occurrences where you have 10 in one pattern, and at that point I don't even bother verifying that if there's more in a second pattern, if I've already established the other two conditions within the other two patterns are viable for a gap. I probably should do that, but because higher indicator counts indicate stronger supporting evidence. However, the other pattern is down touches in the trend chart, and you have to have at least one down touch in the trend chart. And the third pattern that makes up gap identification is the proximity group patterns. And these have two variables inside them. They are categorized by location and they are categorized by shape. Again, they are the same shapes in the 22 market force recognition indicators, or what we call the identical indicator patterns, like the BOC patterns, the TOC patterns, the bottlenose patterns, and right leg W or high M, whatever pattern it is. There's typically about 7 of them that we look at in the shapes patterns, specifically within the proximity group. The locations patterns are basically your power 4, which is power pink, blue, white, and yellow, or your power 3, which is without the yellow. And either the power 4 or power 3 is above the power orange line, and power Zion is under the power orange line. The power orange line is the divider between between an indicator and the groups, or between two groups when we think about divergence. And divergence and line length are the two greatest methods for identifying strength within a market force or pressure within a stock. This video is about the 6 down touches for a gap up situation. When you have those, when you have one of those 6, it can cause gaps up. We like to see other supporting evidence with the 3 primary conditions of the 3 patterns, which I've just described. Additional supporting evidence would be other patterns, like you also have a Zip Zion highest, which means what? Which means people are buying a lot of the stocks. Or you can have, when you're expecting a gap up, you can have a red spike, which is again another pattern which defines a next day up. But what it does is it actually causes the gap to increase when you find additional patterns, provided you have all of the other basic criteria of the 3 patterns themselves. You have to have 12, I say 12 out of the 22 market force identical indicators in 1, 2, or 3 pattern groups. You have to have the down touch in a trend chart, and you have to have the proximity group locations and shapes at that point that you've also identified these other things. The down touches, there are 6 involved, and they all happen to be on this page right here that we're looking at. And I've got a eclipse around the one of those patterns, which is basically the down touch under the 0 line. Before I get to that, I'm going to describe those 6. It's basically to have one of your fast lines, your trend red, green, or gray, down touching one of your slow lines or your 7 short-term trend lines, which is the blue, pink, and yellow lines. The blue, pink, and yellow are the trend group, and there are 3 groups or 7 lines that make up the short-term trend. And on the master platform chart, they're drawn in wide. And you have the option of changing widths if you want. Obviously, you don't have the option of changing colors because the colors are coordinated to the lines by name, obviously. Now, in this particular case here, over on the vertical green line, we see trend green down touching the blue line, trend red down touching the yellow line, and trend gray down touching the 0 line. Over here we see green that's gone under the blue, and it's not really too close to pink, but we call it a green down touching pink line, even though it is higher and closer to the blue line. The red is down touching the yellow, and the gray is down touching the yellow in this particular line. In all 3 of these cases, including this one right over here, all 3 of them are a triple down touch and normally cause stronger upward movements. In this particular case here also, we have a real strong uptrend that looks like it's 7-8 days long. The vertical green line day, in which I've got it identified with the circle. And this one here has a gray down touch blue and a green down touch pink, and the red is down touching under 0. Now remember, when you have the red down touching underneath 0, the day that it crosses 0 is the day that the line reverts or reverses and goes back up. And you want to have, you don't always have, but you want to have certain supporting evidence, if you can find it, that will identify additional patterns. For example, on the I'm going to change this color to cyan so you're relating to where the Zion lines are. This Zion line here in the trend in the power chart is the same as the Zion line over here. Over on the Zion line, on the Zion line in the zip chart, we have a zip pink lowest. Remember, zip pink is your price barometer, along with swing Zion. That's the swing Zion right here in this chart, and the 3 price lines, green, red, and blue. All 5 of those are price barometers, and they tell us, and they track the price. If it's up, the lines are up. If the price is down, the lines are down. And so that relationship is or can be significant when you're doing some comparative analysis in different ways. In this particular example, in the zip chart on the Zion line, we actually have a red spike. However, the red spike is the zip red is at 67 and zip yellow is at 74. And if we remember the basic rules on a red spike, it's zip red is down and under 50 and zip yellow is down and above 50. And so we like to see those conditions, but there is great flexibility to red peaks and red spikes. And we usually go down, yellow can go down to 30, and of course red can go down to 0. And we've all seen zip yellow down under 30, usually not much under 10, and it'll still work as a next day up pattern. The thing I want you to think about, however, is we all think of the strength in indicator line lengths or the strength of divergence. And as I indicated, those are the two primary methods we have to identify the strength in a stock. When we see the opposite pressures, or when we see indicator line lengths stronger than other line lengths or longer than other line lengths. Now, think about what zip red is telling us in this example. Zip red started out yesterday at 84. Today, zip red is at that 67 mark, with zip yellow at 74. So, this day, we pushed the trend red yesterday was at 32, and today it's at -1. And that's a pretty significant move for trend red. 33 points in one day. We like to see those because it usually indicates excessive pressure. By that, obviously, if it's going down, excessive pressure in a sell-off, or if it's going up like a BOC higher pattern on a peak, that's excessive buying pressure. And typically that'll reverse back down again as this example where it goes way down, it's going to reverse back up. I'm going to pull this line away here and show you for a moment what this thing looks like, because you have a red T-top candle on this day. I refer to it as a red T-top doji, and the crossbars are way on the top, but you have a lower tail that looks like it's about $2 long. And so the bears tried to push this thing way down. They ran out of gas, or what they really ran out of was stocks to sell. So at the end of the day, or sometime, the price went way back up. Now, this example that we see of the red down touch under 0 is the fifth. We have the three lines, the blue, the pink, and the yellow, that the red, green, and gray can down touch. We also have the 0 line that the red, green, and gray can down touch. We have underneath the 0 line, it's just an area. There's not anything that it physically hits. It's just an area. But the signal for it is that when the crossover takes place, the following day will be it'll be an upturn. And then we go to places like the zip chart, and we see that we have a red spike. We have pink, zip pink, that I refer to this as it stuck its nose out under all the other lines. Zip Zion did the same thing. Zip Zion shot down underneath the 0, the green, and the red, and the yellow, all of those lines, and bingo, it stuck its nose out under, means it's going to reverse back up. Also, trend green and Zion, zip green and Zion, green's at 48, Zion's at 52. Those are both like a down touch 50 line, which means it's going to reverse back up. And one other key element to this is right here, your swing gray is your long-term deep cycle indicator identifying trends. And it is above 0 and heading up, which tells you it's an excellent opportunity for this example to go up the next day. Now, I have not looked at this as a gap before I started this video, so I don't know how many identical indicators we have, but obviously this did not gap up. But we did have, looks like a 8-day green candle uptrend, which is fantastic. And that is the result of what you see here in the power chart. Look at all the down touches we had onto the green and orange line, and then one of if I've told you one thing to look at first all the time before you decide on a trade, it's look at the short-term trend lines. When they're going up, it's great. When they're above zero, it's great. In this particular case, the trio is above zero, but it's pretty flat. If you look down here in the power chart, you can see orange and green crossed over zero way back here somewhere next to the edge of the left side of the screen. If you go into the swing red and green lines, you find that those again are both over zero. So all your three groups, swing red and green, power green and orange, and your trend trio, they're all telling you that we're in an uptrend, even though the price may not seem like it's going much in the way of an uptrend. But all 6 of those patterns, except for the Sky Touch, is on this chart. And I'm going to move it over a little bit and show you one other pattern. And I'm also going to show you a Sky Touch situation. What I'll identify here for you is the pink vertical line is in a what we refer to as a divergent condition, and by that we mean trend red is a low angle down and power red is in a BOC pattern. They're both lowest, and as you may know, they're both part of the big three, Swing Zion being the third member. Both of these indicators on the zip pink line are telling us that the next day will be up. In some cases, okay, and this is why I brought this, or I wanted to identify this. Sometimes we'll get trend red to drop under zero, and in this case here, which we normally don't see, we have the trio underneath zero. So in this case, if I haven't made it clear before, the green would cross, or red would cross under the blue. We need to get it lowest. Normally the trio is above zero, which makes the zero line lowest. When the trio is not underneath, or when the trio is under zero, we then treat the down touch under as clearing all of the indicator lines. So it does, just like it did today or 2 days ago, it started way up, trend red was at 14, and the next day trend red ended at minus 30.5, and so it dropped 44 points. And so that drop is significant for trend red. That's a big drop, but it crossed zero and it crossed underneath the blue line, and that makes it a possibility for the next day up. And in fact, it gapped down a little and made a green candle on the pink vertical line day, but it did not, the trend red line did not go up. And instead, the trend green crossed underneath the blue. And so this is the exception to the turnaround. Trend green the next day, trend green has to cross under the low line, either the zero line when the trio is above zero, or underneath the blue line when the trio is under zero. When that happens, we then consider that the crossover day as well for the turnaround. because when red crosses under zero in a normal fashion with the trio above zero, that is the signal for the turnaround day, and it reverses back up the next day. Obviously, if you don't have any verification, like a red spike, or maybe your zip Zion line, or some other down touches or up touches to identify which way the thing is going to go, you would then see that the pattern could or may continue. But when you have supporting evidence, like we had on this Zion line over here with the zip or with the red spike going down, and by the way, that red, when the red on that day on this vertical line where the Zion line is on the zip chart, when red only went down, zip red was 84 to 67, I believe. Yeah. Think about it. When it can only go down, those 15 points or whatever that number is, that you should realize that the pressure within that marketplace pushing things up is really strong, because the zip red line, which is a really fast, long length moving line, I mean, it can easily jump 60 or 80 points. It only drops 15 or 16 or 17 points. See, it's like reverse recognition. When you see that it was not pushed, it stayed high. Red stayed up at 67. When that happens, that tells you that you have a real strong upward movement in the market, or in the stock of in the forces within the stock that you're looking at. So it's exciting to be able to read this stuff, but along the same lines, you need to put it together, because it is technical analysis, and that's what it's all about. And these are powerful indicators. They will give you so much information. We spent many years designing them and pairing them together and synchronizing some of them. And so it gives you an ability to read a tremendous amount of information. And all you got to do is read it. And obviously, it's great that you're listening to the videos, because that's where you're going to find the information. I mean, I don't know what percentage is there versus in textual format. But to me, it's a whole lot easier to look at the video and identify what can or should or could change, and recognize how you read the indicators in that way. But the written form is there as well. A lot of people do like to read and verify what they see, and I encourage that. Now, I had one other thing. Oh, this right here. I'm going to move this pink vertical line. This is the last comment I'm going to make on this video. And this right here is, if you look at it, 3 days earlier was the trend red crossover green, which means it's the start of an uptrend. And so the following day you had a red candle, and then a long green candle, and then on the pink vertical line day you had that green candle. What this also is the maximum day that we look for gaps after the sky touch reaches the third day after the crossover. So you can have gaps on the crossover day. You can have gaps on day 1, you can have gaps on day 2, and you can have gaps on day 3, which is the pink vertical line. But look at what we had. We had a pretty nice green candle. It looks like it gapped up a little bit, but it's not a whole lot. It closed on the vertical pink line day at 2102 and opened at 2116. So it's nothing big. But we got a pretty nice green candle. And my point is that we had a lot of conditions for the movement up. When I say that, I'm specifically talking about the low angle in the trend red, as well as in the power red. And if it gaps up, then you end up with what? We end up with a bottlenose. So the following day, the day after the pink vertical line here, we get a bottlenose, which is an automatic reversal pattern that tells us it's going to go down the next day, which it does. And so the indicators will tell you so much. It's amazing. But all you need to do is learn how to read them, because you don't have to be inconsistent trading. You don't have to lose money trading stocks. Within the power of the eyeglasses of the DTVB system, you can see what's going on and make reasonable or large profits trading. So we, if you haven't figured it out, are excited about this system. We are amazed at it on some days and challenged by it on others. Sometimes we see a movement and don't recognize what the specific conditions were. One of the key things to remember is divergence. When divergence occurs, it doesn't necessarily mean that it's going to be the next day. In fact, divergence often has a 1-day delay, sometimes a 2-day delay before the reaction takes place. I mean, then again, gaps are classic same next day patterns. But divergence, whether it's 1 day, whether it's next day in a gap or 2 days later in the form of a uptrend or real strong green or real strong candles I'm thinking a long buy here, it doesn't make any difference. They're both winners, and your win-win ratio is without any doubt is going to increase, because it really makes a difference what system you are using to pick the next trade you've selected. And with this system, we have patterns that we've recognized with historical information that verify gap or verify strong up movements, and we've identified the conditions that make up those strong movements in that pattern, and we share those with you. We identify how they work, and the only thing we need do is we select a few patterns and we carefully look them over and make a decision on which one to buy after we've verified the conditions. And then we use a signal to tell us the timing on it. And typically, you're going to buy. Next morning you're going to make a decision on a buy, and if you've made a decision to get into the stock, it opens. And again, if it's a green candle day expected, it's going to open, and it's going to go down a little, and then it's going to come back up and fill the body of the candle and go up most of the day, or a good portion of the day, excuse me, before it reaches the peak, and then it's going to go back down and form that upper tail. So it's amazing. What can I say? You can talk about the indicators, you can talk about the formula power, you can talk about the procedures power. When you spend your time analyzing those different opportunities, and every time you do, you become more familiar with how the indicators look in relation to price action next day. And that's the secret. With large numbers of leading indicators as the indicators that we use, We have the ability to see things that other indicators won't show you. And by watching the videos, you can see a lot of those. Excuse me. But this is a great example of what I've shown you about those types of relationships between the indicators. I encourage you to listen more. I encourage you to come back and listen, even if you've joined the system and are actively trading. Come back and refresh some ideas. I mean, there's well over 200 videos on this website, and there always seems to be another idea that you can pick up by coming back. So do that. Keep yourself educated. Keep learning about what makes it tick. And if you haven't joined the newsletter, you can do that, because each week as we find something unique, we typically will post that on the newsletter and show you how the indicators work in that particular example, or identify something unique within that example. So that's my plug on the newsletter. Enjoy your time trading, have fun. When I was losing money back in 2007 and wondering what was wrong with the whole thing, it wasn't fun. I spent 20 years developing real estate, and 20 years before that selling homes in the Minneapolis, St. Paul area. That was all fun, but those few years of trading, when I was trying to learn the system, when I didn't have a system, when I thought I created some indicators and two more indicators gave me a system, and they really didn't give me a system. The only thing they gave me was two more indicators. And not until the patterns were discovered out of these indicators that we created. Because I spent years looking for another indicator. And finally I decided I've got enough. I've got to go to the next step. And the next step was finding those patterns of historical movements that created large movements. And those we ended up calling patterns. And with the patterns came the conditions, which we verify, which gave us 95% or higher high probability ratio if we traded only those patterns with those good conditions specific to those patterns, and then resulted in excellent trading profits, which in turn gave us more confidence, which helped us build our level of willingness to risk and be the beneficiary of those risks that we take in those high probability situations. So there's always a chance of losing. Don't let me make you think that it's not there. It's just that the better you become at identifying and verifying the conditions within this specific pattern that you're looking at, the better the results are going to be. So each of us are different. Each of us learn at different rates. If you're going to follow the system and you're going to put in and you're going to fill in the trade logs like you're supposed to, you will come across key patterns that you're more successful at, and just trade those patterns until you figure out the others. Because it's really simple. It just sounds